Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Donald Trump and Kamala Harris planning dueling economic addresses. Trump speaking in Georgia tomorrow, offering his plan to lower taxes for business owners. And Harris saying she'll deliver a speech this week outlining her economic vision. We get lucky this morning. We're joined by Jason Furman, the professor at the Harvard Kennedy School and former chair of the Council of Economic Advisors under President Barack Obama. Jason, welcome back to the program, sir. It's been far too long. Before we get to the election race, let's just talk about the state of the economy. So a lot of people are still talking about whether we can achieve a soft landing. Do you think it has been achieved already?
I think we're close, but the next core PCE reading on a 12-month basis is going to be probably 2.7%. So inflation isn't all the way there, but labor markets are loose enough. I think inflation is coming down, but there's still narrow perils on either side of reinflation and recession, but a broad path to a soft landing in between those.
Politics, one of the big risks, at least according to R.D. Ardeni, who is just on with us. You wrote this terrific op-ed in the Wall Street Journal, terrific writing. I want to start with just the lead sentence. The first modern presidential race between two candidates with undergraduate degrees in economics hasn't thrilled economists. Why not, Jason?
You know, campaigns are never the place where you're going to completely thrill economists. But, I think an awful lot is the voters want to hear incredibly simple solutions to things. Price gouging, stop Japanese investment in U.S. steel mills, whole new areas that aren't taxed like tips. And, none of these are ones that any economist would recommend. But, there's just quite a lot of pandering out there.
Well, but at this point, some people would say we always get this to some degree, right? I mean, we get pandering, we get promises that don't get fulfilled. You've been in the political sphere before. How different is this time?
It feels a bit different. Look, there's, by the way, things I like in these campaigns, too, especially an awful lot I like in the Harris campaign. So I don't want to say it's all negative. It feels like more because there's more things around limiting trade and controlling prices, a certain type of government intervention, as opposed to the standard, promising lots of tax cuts or spending increases is more the normal thing. This feels to me, more interventionist, more getting in the way of markets right after they've actually been really quite successful.
And Jason, aren't they both doing this? I mean, Kamala Harris is talking about price gouging on the federal level, and then you have Donald Trump over the weekend talking about capping credit card interest rates. Aren't these both proposals price controls in the U.S. economy?
Yeah, I mean, Donald Trump doesn't seem to be the type of person that respects free markets, competition, and all the things that go into it. He believes very much in a strong government. When he was president the first time, he tried to direct investment this way and that. So yeah, I don't think he's a particularly free market guy.
Can you give us a sense of how you view, if Donald Trump's not a free market guy, who is Kamala Harris?
I'm looking forward to that speech this week. I think we'll hear more about how she defines herself economically. To a first approximation, you can expect a continuation of the types of policies we saw in the Biden administration. But remember, a very, very different context. I thought the initial stimulus was too large, but that's not going to repeat itself. We're not going to have, hopefully, knock on wood, another massive global pandemic that will create the conditions for something like that. So, there have been some whispers about being more pro-business. She spent more time with CEOs than President Biden did. Pro-business has its pros and cons, but on balance, I think wouldn't be a bad direction to move just a little bit in the way of right now.
How different would we see a Kamala Harris as a president if we get a sweep versus gridlock in Washington?
I'm not sure about the whole theory that gridlock is the most fiscally responsible outcome here. With gridlock, you're going to be able to extend an awful lot of the tax cuts it's going to make it hard to enact deficit reduction. And in the past, you've seen the parties make deals where one party gets extra defense spending in exchange for the other getting non-defense spending. So the whole gridlock is good for the deficit thesis. I'm really not sure I believe. If you had a certain number of Democrats there, there's taxes you could raise that you couldn't raise in divided government, and that might result in a lower deficit than you'd otherwise have.
Jason, I want to finish where we began. You began by saying that economists don't like the kind of tariffs that either side are proposing, the kind of limits to trade that we're seeing proposed. And yet we've seen increasing threats to the supply chain. We've seen increasing questions about, national security issues raised by certain fissures, the breakdowns that we've seen. If we do get some of these gates, some of these tariffs, which both sides are proposing, does that increase the risk of inflation, a reignition of inflation in a really material way next year?
Yeah, look, on tariffs, there's a massive difference between these two candidates. Donald Trump is calling for 10 to 20% tariffs on everything coming into the United States. That's stuff that we're just not going to be making here, like ballpoint pens. That's stuff coming from countries that are close allies, like Australia. There's just no coherent theory around that, and it's just at a scale that dwarfs anything that you've seen done in the Biden administration, or I think plausibly would be done in the Harris administration. So absolutely, you follow through on the Trump tariffs, you are going to get a burst of inflation and a real quandary for the Fed, because it'll both lower economic growth and raise inflation at the same time.
Jason, we've got to leave it there. We'll continue that conversation on the Fed and the prospect maybe of rethinking rate cuts with rate hikes in 2025, if that is the direction of travel. Jason Furman there at the Harvard Kennedy School. Let's turn back to the markets. Equity futures right now up 0.25% on the Nasdaq 100. Looking ahead to a busy week of data and Fed speak. Pooja Sriram of Barclays saying the following: even the 50 basis point cut appears to have been a close call. The outcome bears the distinct imprints of a compromise, with hawks trading the 50 basis point cut in favour of hawkish messaging and a relatively high bar for the unemployment rate to warrant another aggressive cut. Pooja joins us now for more. Pooja, I just want to get to your growth outlook, and I just want to sit on your GDP outlook. Did you raise your GDP outlook after getting that surprise move from the Fed last week?
We did. Good morning, first of all. We did raise it by about 0.5 percentage points for the end of Q4. So we're still penciling in 2% growth for the fourth quarter of this year. And then we've got a similar pace of growth, in fact, through the end of next year. Some of that was, of course, the easing in financial conditions that we've seen over the past, couple of weeks. We track the Fed's FCIG measure, which translates, financial conditions into the impulse for growth. And it does suggest that growth could look better. So, yes, to your question, we have raised our GDP forecast modestly in the near horizon. Yeah.
How does that line up with your view on the Fed's next move and the moves through 2025?
Yeah, that's a good question. So look, our own baseline is for 225 basis points cuts this year. So that's, broadly in line with the median projection for 2024. For 2025, we've got 325 basis points cuts. So that's a total of 75, as opposed to the 100 basis points cut that the FOMC median has. And that's really predicated on the view that, the economy is going to look pretty decent. We don't have the unemployment rate staying, at 4.4%, which is what the FOMC has. We, in fact, do see it ticking lower. So we do think that, they could afford to slow the pace of rate cuts going into 2025.
Pooja, you wrote something in your recent report that I thought was fascinating. Whatever was gained by the Fed's 50 basis point rate cut may have come at a significant cost. And you go on to say that it seems quite likely that similar Wall Street Journal articles, akin to what we saw ahead of this latest 50 basis point rate cut, during that blackout period coming up, any blackout period, will be interpreted as legitimate signals, leading to unnecessary noise. This cost may well exceed whatever benefit the Fed achieved by front-loading one cut, in our view. Can you just elaborate on how much this adds to potential uncertainty for you?
Yeah, I think that's a great point. So, just to take a step back and to recap what happened Before the Fed went into the blackout period, we had a bunch of data in hand. I think the last print we had was, the non-farm payroll. We heard from FOMC officials, namely, Waller, FOMC member Williams, and the markets were essentially quite content to price in a 25 basis points rate cut. That was our baseline as well. Everything looked good. And then, as you mentioned, we got a bunch of these articles, and suddenly it raised the question and put the possibility that the Fed could perhaps, go a little more aggressive and go 50 basis points. And then, the pricing moved. And surprisingly, the Fed actually ratified that move in market pricing. And we found that quite surprising, to be honest, because it did not come on the back of data, and in fact came on the back of a bunch of articles. And what this means is if something like, if there's a precedent for this now, it's quite possible that there's going to be a lot of noise and volatility around the blackout period if we get more news information this way. And in terms of the fact that the Fed did not gain much is, the markets are still pricing in about the same amount of rate cuts as they were before the news articles came out. So it's not very clear to us what the Fed achieved by ratifying market expectations going this route.
This might sound like a dumb question, but what is the actual economic cost, though, of a little bit more volatility around the blackout period?
Well, I think it can get markets to run away with expectations. It's you would think that the data, hard data on economic activity, what you're officially hearing from the FOMC guides market expectations. But if you have something like this, it can lead to a lot of volatility. Market pricing could go different ways. And then if the Fed outcome looks very different to how the markets have moved, it can create financial market volatility. So I think that was the point that we were trying to make, that it creates unnecessary noise, especially after an era where Fed communication has been really on point and they've really made an effort to do this so well.
Given this, do you think the Fed now has a credibility problem?
Doesn't seem like it. When we think of monetary policy credibility, we do tend to look at inflation expectations, right? The credibility comes from the fact that how committed are they towards their dual mandate. And right now, there's no question that they're very committed. It does seem like the focus is a little bit more on the labor markets than it is on inflation, as it should be, given the inflation outcomes are pretty good. So I think it's too early to start questioning any of that, but it does create a bit of a kink in the communication policy.
Pooja, we've got to leave it there. Appreciate the catch up. With us around the table to continue the conversation, Bob Elliott of Unlimited. Bob, good morning and welcome to the programme.
Good morning.
What did we achieve with a 50 basis point rate cut last week at the Federal Reserve?
Well, I think the biggest thing that the Fed highlighted was that they were trying to paint the picture of a strong economy and sufficient disinflation that they can deliver big cuts relatively quickly into that scenario. Now, you can argue whether you actually believe that that's true, but I think the path that they're laying out, they're committed to, and they believe it's data-driven because they believe that the inflation numbers are going to get back to their 2% mandate. And that's very interesting for markets. It might be too easy into a hot economy, which has got a lot of effects, second and third order effects that they might not expect.
Are you a believer
in disinflation? No, probably not. I think the thing that's interesting, inflation is still running above the Fed's mandate. We have to remember that, no matter how you slice it. And easing into that environment when you have a hot economy means that we're probably more likely to get acceleration rather than deceleration ahead. The thing that's interesting about that is that the Fed probably won't see that data come out until they've cut a few hundred basis points. And only then will they be held accountable for the fact that the disinflation might have reversed. And so I think it's a tricky period over the course of the next, 15, 18 months when the Fed isn't going to get the feedback loop that their policy is too easy.
Just to put a bow on that, are you saying that right now the risk of a reinflationary kind of moment is greater or less priced into a market and more real than, say, a downdraft in growth?
Well, certainly it's less priced into markets. When you look at long-term inflation expectations, the expectation is for inflation to be at 2% or below 2% essentially forever. And given the geopolitical dynamics, given the Fed's easing into a relatively strong economy, given the fact that you still see a lot of sticky dynamics in inflation, particularly related to wages, which are showing some signs of reaccelerating. That whole picture doesn't really align with the probabilities of, a certainty around 2% inflation, and much more likely that we have higher inflation ahead rather than lower inflation.
Normally somebody with that kind of view would be bullish, because if you believe in this sort of strong economy that could foster some reignition of inflation, that would be probably positive for equity valuations. But you wrote the stock market is priced to perfection. And so far, this quarter is providing plenty of data points that the perfection is unlikely to be achieved in reality. Why?
Well, I think when you're trading markets, you got to trade against what the price and expectations are. And we're at PEs that are, almost as high as they were during the tech boom. We have forward earnings growth expectations in the mid-teens. That's a pretty strong scenario, already priced into the markets. Now, the Fed is helping that along, and that's probably a positive. But I think the story is much more around being long stocks relative to bonds, because that's the scenario, of the growth reacceleration that probably isn't fully priced into the market.
Let's introduce China into the conversation. They're now exporting disinflation, perhaps even deflation. How do they factor into your worldview right now?
Well, China's experiencing debt deleveraging, akin to what happened in Japan and akin to
sort of classic balance sheet recession.
A classic balance sheet recession, and the policymakers there are maybe driven by motivations that are not related to macroeconomic policy, more like political motivations. And so, for whatever reason, they're choosing not to respond to the situation. And so, China's probably in this malaise for the foreseeable future. I think the effects on the West are actually relatively limited, and the reason why that is China's deflationary impulse has been basically the same for the last couple of years. Probably China is not going to accelerate in terms of getting a deeper and deeper or a worse rate of deflation going on in the economy, and if anything, we've seen it tick up. And so the big picture is it's probably not the main story that's going on. When you're looking at U.S. inflation and Western inflation in general, what really matters is the labor markets. It's all about the labor markets. It's all about that wage data. If you look at the Atlanta Fed wage tracker data, we're 1 to 2 points above where we were pre-COVID. And unless you believe productivity has matched that increase, that's an underlying inflationary pressure that remains in the economy.
But Bob, isn't the deflationary pressure coming from China has everything to do with the commodities market? Isn't that helping Western economies?
Yeah, it certainly is an effect on the commodities markets. And if you're trading, copper or other direct commodities that China has a meaningful share of, that's going to be a meaningful influence on that supply demand. But the flow through of that to the U.S. inflation picture, it's pretty tiny compared to rents, labor, the other sort of imported, imported goods costs that, cars, new cars, used cars, all of those things represent a much bigger impact on U.S. inflation and U.S. policy.
Liz Young-Thomas, our guest at the top of the hour, was talking about one risk would be reacceleration of commodity prices. Do you see that where China is right now?
Commodity prices have basically been trading, and particularly oil prices, which is really the thing that matters, have been trading in a tight range over the last couple of years after the move down 18 months ago. I don't see meaningful pressures on the upside or the downside. On the downside, you've got a natural cap in terms of, suppliers taking oil barrels off the market if oil prices start to fall a little too much. And on the upside, there's still a lot of incremental production. U.S. production is near all-time highs. A lot of production that can come into the market to put a cap on it. So that's probably not the big story here. It's much more about the sticky inflationary pressures in the economy on the forward-looking basis.
How much would longer-term yields have to rise to make you a buyer?
Well, I think at this point, you've got to see inflation expectations move up considerably here. So I think, easily into the mid-4s before you start to have a real conversation that's an attractive bid, particularly relative to stocks in a stronger growth environment.
When you say inflation expectations, you're talking about market-based pricing, or are you talking about consumer surveys, the likes we see from you, Mitch, every other Friday? What are you looking for? Mostly in terms of trading the bond market, it's all about price and break-even inflation. And so that's the thing that if you look at the market's basically priced to be, at 2% or below.
low essentially forever, or inflation swaps. That's what you're trading. And those are the areas of the market that look particularly underpriced. The reality is, if you're going to get exposure to duration right now, buy the tips. Right? You're seeing real yields that are still pretty good on any long-term perspective, around 1.5% to 2%. That's a pretty good real yield if you can lock it in for 20 or 30 years without any risk.
Bob, it's good to see you. Let's do it again soon. Thank you, sir. Bob Elliott there of Unlimited on this bond market.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.